Most people think investing is all about picking the next big winner, but here's the truth. The biggest losses I see aren't from choosing the wrong stock, they come from making the same avoidable mistakes over and over again. I've met so many people who worked hard, saved diligently, yet still fell short of their goals, not because the markets failed them, but because their own approach did. And the difference between reaching your goals and missing them often comes down to simply avoiding the traps that many investors fall into without even realizing. In this video, I'm going to walk you through the 7 most common mistakes that hold investors back, and more importantly, how you can avoid them. Whether you're saving for retirement, building toward a future purchase, or setting aside funds for your kids' education, this is for you. By the end, you'll know the key principles that keep your money working, your stress lower, and your goals on track, no matter what the markets throw your way. If you're new to my channel, welcome. I'm Jacqueline Ozdemir, a financial advisor here at Ferguson Financial Planning. I work with people across Canada who want to simplify their wealth, pay less tax, and actually feel confident that their money is set up to support the life they want. And I've seen firsthand how even really smart investors, folks with good discipline, get trapped up by the same investing habits that quietly chip away at their outcomes. And that's exactly why in this video, I'm going to walk through 7 of the biggest investing mistakes I see most often and how you can approach them differently. I'll show you why starting with clear goals keeps you steady, why the mix of your portfolio matters more than the individual stocks, how to diversify without overcomplicating things, why timing the market doesn't work, and a few other key themes that will help you cut through the noise and stay on track. If you find this video helpful, be sure to hit like, leave a comment below, and don't forget to subscribe and turn on notifications so you don't miss a future video. All right, let's get into it. Let's start with one of the most common pitfalls: putting too many eggs in one basket. Now, we've all heard about diversification. It's a term that gets tossed around a lot, but let me break it down in plain terms. Diversification is simply the idea of spreading your money around different types of investments so you're not overly exposed to one. Think of it like a hockey team. If you stack your lineup with nothing but flashy goal scorers and don't balance with defense and goaltending, it looks great for most of the season. Then spring rolls around and, well, it's another early exit and a lot of long faces. That's what an over-indexed portfolio feels like: exciting on the good nights, exposed when the pressure hits, build balance, offense and defense, a steady goalie. The problem happens when investors get caught up in the excitement of a particular sector or stock and load up way too much on it. Maybe it's tech stocks, maybe it's real estate, or maybe it's even just one company they believe in. But here's the thing: when you concentrate in one area, you're setting yourself up for big swings. Market history shows us this. During the tech bubble, the NASDAQ composite fell about 77%. If you had concentrated heavily in tech going into that period, you would have seen massive losses when the bubble burst. Same thing during the 2008 financial crisis. Even in Canada, that hit investors hard. The S&P TSX composite dropped 35% in 2008, which saw people who held only equities see a huge drawdown in their wealth. Now compare that to someone with a balanced mix: some equities, some bonds, maybe a little real estate, some international exposure. That person would still have taken a hit, sure, but a smaller one, because while some parts of the market are falling, others might be steady or even rising. Successful investors lean on diversification for stability. It doesn't guarantee a profit, but it's like shock absorbers on a bumpy road. It smooths things out. Case in point, someone with $500,000 invested only in Canadian large cap stocks in 2001 would have seen a 12% drop in that year. That's a $60,000 loss. But the same amount spread across a diversified portfolio at that time, bonds, international stocks, commodities, would have seen much smaller losses with a higher average return over the 10-year period that followed. And that difference changes everything, because recovering from a 50% loss takes a full 100% gain just to break even. That recovery timeline is brutal if you're too concentrated. The key takeaway: make sure your portfolio is like a team. Balance your players: large cap, small cap, international equities, and alternative investments, so that if one is having a bad season, the whole team isn't failing. Next up, trying to outsmart the market's short-term ups and downs. Everybody wants to buy low, sell high. Sounds simple, right? But I'm going to let you in on a little secret. Even professional money managers who spend all day analyzing the markets often fail at this. Timing the market consistently is like trying to predict when it's going to stop snowing in March or April in Toronto. You might get lucky 1 or 2 times, but predicting it day after day is almost impossible. Morningstar did a study that's worth pointing out. They found that on average, investors underperform the very funds they invest in. Why? Because of timing, chasing performance when prices are up, panicking and selling when prices dip. Investors actually erode their returns simply by jumping in and out. Here's a relatable example. Imagine you had $100,000 and you left it all in the S&P 500 for 30 years. Over those 3 decades, had you stayed invested in the market the entire time, you would have netted almost 9% returns. But if you start to pull out of the market and miss even the 15 best days of the market in that 30-year period, your return almost drops in half. And those best days often come right after the worst days, which is when people are most tempted to sell. And as you can see from this graph, the more you are out of the market, the lower your returns become. So the act of guessing when to move in and out can devastate long-term results. Dollar cost averaging is a great approach here. Instead of waiting for the perfect time, you invest a fixed amount regularly, say monthly, rain or shine. Over time, this means sometimes you buy when prices are high, sometimes when they're low, but it all averages out. But more importantly, it forces discipline and gets rid of any emotional decision making. So what does that mean for you? Forget about trying to catch tops and bottoms. It's time in the market, not timing the market. That does the heavy lifting for your returns. Let's step back for a second to look at mistake number 3. Why are you even investing? Most of the mistakes we're talking about tie back to this simple question. Having unclear goals is like driving a car without knowing the destination. You might keep moving, but you're not really sure if you're heading in the right direction. The type of investment strategy you use depends entirely on your goals. If you're saving for retirement in 20 years, your portfolio should look very different than if you're putting money aside for your child's university tuition in 5 years. Yet a lot of investors just chase returns, thinking higher is better. But the truth is, chasing high returns means taking on more risk than you may need to. Think about a couple planning to buy a cottage in 5 years. Their real goal isn't maximize returns. Their goal is make sure we have enough cash for the down payment when the time comes. That's a completely different objective. If they put all their savings into aggressive equity funds and the markets take a downturn, that dream cottage could slip out of reach. If instead they choose a steady mix of bonds and balance funds, the returns might be more modest, but the certainty of having the money when needed is much higher. And here's the trap. Many people measure themselves against the S&P 500 or TSX performance, but that's not a fair comparison. The market doesn't know your goals or timeline. A retiree drawing income needs stability, not maximum growth necessarily. So why hold yourself against a benchmark that doesn't even apply to your situation? The lesson here, define your goals clearly. Retirement at 60, a renovation in 10 years, funding education. Once you know what you're aiming for, you can figure out how much return you actually need. Often it's less risky than you may think. That takes the pressure off, and it shifts your focus from chasing the market to building a strategy designed with purpose. Now, let's talk about the media and social media advice. You're literally here watching me give out advice on a social media platform. So here's the irony. You need to be very careful about who you listen to. A lot of investor underperformance happens because of emotional reactions, often triggered by external voices, headlines, TV, influencers. Here's an example I see often. Someone watches a YouTuber recommending a trendy stock. Let's say it's an electric vehicle startup. They jump in because it sounds exciting. But that influencer doesn't know that the viewer is, say, 3 years from retirement and actually needs stability in their portfolio. That advice might fit a 30-year-old with decades to invest, but for the retiree, it could be disastrous. And it's not just online influencers. Even traditional financial media can be a problem. Watching daily market news builds anxiety because it's focused on drama. Markets up 2% today, markets down 3% tomorrow. If you watch that every day, your instinct is to react, switching investments constantly. But the truth is, markets swing short term. It's the long-term trends that matters. Only you know your situation, your goals, and your timelines, and the only advice worth following is advice that is tailored to those realities. Be informed, sure, follow economic updates, understand what's happening broadly, but filter advice carefully. Not all good tips are good tips for you. So don't let your investment decisions be swayed by social media posts or quick headlines. Instead, anchor your decisions to your own strategy. Otherwise, you risk sacrificing your own goals for someone else's excitement. Let's move to the flip side of diversification, overdoing it. Yes, diversification is important, but there's such a thing as too much. There's also a term for this concept, and it's called diworsifying. Essentially, that's when you add so many assets to your portfolio that you lose the benefit of focus. Think of it like watering down juice. A splash of water is fine, it balances the taste, but add way too much and you're left with a bland drink that nobody wants. Same thing with investing. If you already own a US equity fund that holds 500 stocks and then you go buy 2 or 3 individual US stocks, you're not really diversifying anymore. You're just overlapping. The risk profile doesn't change, but you've added complexity and maybe extra fees without any new benefit. Diversification can happen in a number of ways. Sometimes it's impulse investing, and other times it's just a change in one's investment approach. Here's another example. Let's say someone holds a Canadian equity mutual fund with exposure to all the major banks and telecom companies. Then they go and buy individual shares of RBC and Bell on the side. They feel like they'd added something extra, but really they just doubled down on the same sector. In reality, they've increased concentration risk while thinking they diversified. And that's diversification in action. So how do you avoid it? By making sure that each investment you add brings something new to the table. If you hold equities, maybe add asset classes with different risk-return behaviors, bonds, real estate investment, trusts, commodities, or even international markets. The key is correlation. Effective diversification means mixing things that don't move in lockstep. Bottom line, diversification is strength, but only when done thoughtfully. Don't just collect investments like hockey cards. Each one should serve a role, otherwise you're just adding noise. Now here's a tough one. Patience. Honestly, this is where a lot of investors trip up. We live in an instant gratification culture. You can order groceries, stream a movie, or even do your taxes online in minutes. So we start to expect the same from investing. But investing doesn't work like that. Here's the reality. The long-term average return of the stock market is about 10% per year. That means on average, your investments double roughly every 7 years or so. But here's the catch. That's an average. You'll have years where your portfolio might drop 20% and other years where it rises 30%. The journey is bumpy, but over decades, it does smooth out. Morningstar highlighted how unrealistic expectations often cause investors to bail out of good investments at exactly the wrong time. Imagine someone who buys into a solid mutual fund. The first year, it drops 10%. Frustrated, they sell. The very next year, however, the fund is up 25%. So guess what? They missed out on the rebound. This isn't a rare situation. It's incredibly common, actually. A case study here, take a $100,000 investment. In year 1, the market drops 7%, dropping the portfolio down to $93,000. In year 2, the market drops 8%, dropping the portfolio to around $85,500. In year 3, the market rebounds with a 35% return. The $85,500 jumps back up to $115,500. Over the full 3 years, that's roughly a 5% annualized return. Not spectacular, but solid and positive after a tough start. If you had sold after year 2, you would have locked in a 14.5% loss instead. The takeaway, markets often recover, and those who stay invested give themselves the chance to benefit from that recovery. Selling during downturns turns temporary pain into permanent loss. Those 72,000 jumps back to about 133,000 over the 3 years. That works out to about 10% per year on average, which is right in line with the long-term market performance. The patient pays off. Selling early would have locked in losses. So patience isn't just a virtue in investing, it's the bedrock of returns. Keep expectations realistic, portfolio growth is slow and steady, not a lottery ticket. Finally, let's tackle the fascination with stock picking. Everybody loves the story of buying the next Apple or Shopify early and watching it skyrocket. But here's the truth. Even the professional managers with teams of analysts struggle to beat the market consistently this way. For individual investors, the odds are stacked against you. What really drives returns is something less glamorous but far more powerful. Asset allocation. Studies show that more than 90% of portfolio returns come down to how you divide your money between different asset classes: stocks, bonds, real estate, cash, and so on. Take the Canada Pension Plan Investment Board, for example, which manages billions for Canadian pensioners. They emphasize this exact principle. Their strategy isn't about stock picking, but about how to strategically allocate across asset classes and regions. Imagine 2 investors. One spends hours researching which stocks to buy, switching constantly. Another decides on an allocation rule, maybe 60% equities, 30% bonds, 10% alternatives, and rebalances once a year. 10, 20 years down the line, it's the second investor who is more likely to have better, steadier returns simply because they focused on the structure of the portfolio, not the individual bets. Think of it as preparing for dinner and deciding on the type of meal and balance of food groups you want. How much protein, vegetables, carbs, and fat each dish have. You're deciding the overall recipe and nutritional balance. Example, I'll make a balanced dinner. 40% protein, 30% vegetables, 20% carbs, 10% fats. This determines how your meal, portfolio, portfolio will generally taste and nourish you or perform over time. Picking individual stocks is like choosing the specific ingredients within each group. Chicken versus salmon for protein, broccoli versus spinach for vegetables, and rice versus potatoes for carbs. Focus on the balance of your meal, not the specific ingredients. Getting the proportions right matters more than choosing between chicken or salmon. So let's pull this all together. We talked about diversification, resisting the urge to time the market, setting crystal clear goals, filtering out bad advice, and avoiding diversification, having patience and focusing more on asset allocation than stock picking. Each of these isn't just a neat little tip on its own. They actually work together like gears in the same machine. And here's why this matters. Think back to the case studies or examples we walked through. Those are real scenarios that have happened to real people. So learn from others and make sure you're not making the same mistakes. An overly concentrated portfolio, it cost someone $60,000 in a single year. In patience, that could have meant cashing out at $85,500 instead of riding it back up to $115,000. And that's the point. Avoiding these mistakes isn't about chasing some perfect strategy. It's about keeping more of what you've worked so hard to earn and giving your goals the best chance to stick. At the end of the day, successful investing isn't about being clever, it's about being disciplined. When you sidestep these common traps and stay focused on a simple, structured plan, you're far more likely to look back years from now and feel confident that your money actually did the job you wanted it to do. If even one of these ideas made you pause and think about your own money, that's your signal. It might be time to take a closer look at your plan. And I'd love to hear your perspective. Which of these traps do you think is the hardest to avoid? Drop your thoughts in the comments below. Your experience might help someone else watching this too. Now, if you're wondering how all of this connects back to your own investments, or maybe you're not convinced you have a strategy worth following in the first place, the next step is simple. Book a discovery call using the link down in the description. We'll sit down, look at your situation, and figure out how to structure things to keep more of what you earn working for you. And of course, if this was helpful, hit subscribe and turn on notifications so you don't miss the next video, where we'll keep breaking down complex wealth planning into clear, doable steps. Thanks for tuning in, and I'll see you in the next one.